Our featured guest is Jack Ablin, the Chief Investment Officer at Harris Private Bank. Jack, I want to kick things off with you. Scott Black just talking about all the money in money market funds, talking about so much liquidity and how that's going to help propel the market higher. You buy that argument?
Not only do I buy it, I've been beating that drum for nearly a year. In fact, at its peak at the beginning of this year, that money market funds represented nearly 70% of the capitalization of the S&P 500. So, I get excited when it's above 25%, and we're still at, 34, 35% now.
What's going to take, though, Jack, in your view, to get all that money on the sidelines in money markets back into the market?
Well, what it's doing, keep in mind, unfortunately, most of that money is not filtering directly into stocks. What it's doing is it's moving incrementally. The Fed is holding interest rates at zero. That's prompting investors to look for some other place to gain some incremental yield. Most of them have moved into the bond market, into the municipal market, and that's helped bring interest rates and the cost of capital down. So using that as the denominator, that's helped perpetuate a nice stock market rally. And, as Scott alluded, we've got 30% left. We've essentially drawn down about half. We still could get another, say, in my mind, about 15% or so more of momentum to the upside here.
Jack, we talked with Marianne Bartels yesterday, and she, too, we were saying, everything's been so good or seemingly so good for so long at this point. Are you anticipating, Jack, some kind of correction at this point?
Well, I look at a couple factors. I look at valuation. I look at liquidity, as I mentioned, economy, and the momentum. And what I find is that, momentum is certainly still pretty strong, but valuation after the 60+% rise from the bottom has now pushed valuation to, clearly full value. I will say, based on the price to sales ratio, investors are expecting a 10% rise in top line growth over the next 4 quarters. Carol, it's certainly achievable, right. But I will say that based on that, you got to put it somewhere between best case and most likely case. I think market can run, but I also think there is some limited upside from here.
You do say, Jack, that you expect the market to move higher unless there's strong evidence for further contraction here. What kind of evidence are you looking for? What could be a sign to get out?
Sure. So, most of the gains that we've enjoyed have been a result of the tailwinds on the economy. And we all know that those tailwinds have been somewhat artificial. They've been prompted by federal spending, monetary stimulus, and to the extent that that stimulus goes away next year, that we ultimately have to take this patient off life support. I'm looking underneath the surface, and I don't see much of a pulse. So as investors anticipate the end of all of this stimulus, it's possible that that could lead to a turn of events for stocks.
Jack, let me just break in. We're just a few seconds away from the closing bell, but what's going to say to you that the market temperament has changed here?
Yeah, one of the things that I look for is change in momentum. Momentum has been a powerful factor in gauging where to get in and where to get out of this market. Right now, if you use some basis of the 200-day moving average, that would be a pretty good place to start. So if we break down below, that could be a good exit point, so to speak, next year.
All right, we've got the close. Let me throw this one out to you. We talked about Citigroup. They've been pushing. It looks like all the stories saying that they're really pushing to pay back their TARP money. Is it a good thing that investors are enthused about these banks paying back the TARP money?
Sure. I mean, absolutely enthused. That's good news. We want to see investor confidence. I was encouraged that Bank of America was able to raise something like $19 billion in 15 minutes last week on news that they were looking to raise money to repay TARP. So, to the extent you can gain confidence in some of these behemoths, that's great news for the market in general. Remains to be seen how the Citigroup story plays out.
Jack, you guys did a study looking at the market now versus the 200-day moving average since 1926. What did you guys find?
What we found was that if we start at every point where the market is about between 15 and 20% above its 200-day moving average where it is right now, and then project out 12 months, we found that the market tends to move up another 15% on average. So, I guess to play this out, as I said, valuations are full, but they're not, I would say, at a bubble level or anything egregious. On the other hand, we could probably sustain another 15% move, and and that could take it higher.
All right.
Let me ask you, Jack, talking about momentum in the market, what do you see as far as just the straight economy here? I mean, we were talking with Michael Arenstein earlier, who is among few who still believes in a V-shaped recovery. What do you think we're looking at?
Well, I'm a mathematician, so I'm going to look at a square root-shaped recovery, which means that we get this little bump up, but then we go sideways for a while. So, my sense is that, once you strip away the stimulus, and I've tried to do as much work as I can, looking beyond just the stimulus program that will, Dan has, said it'd take us likely through October, then we have to start creating jobs. And here's my issue. The natural rate of growth of this economy is around 3. The fact that we've got to pay back our debts and spend less than we earned for a while means that we're likely to grow at 2, which means at 2% we're going to create about 100 to 120,000 jobs a month. That's going to take 6 years or so to get those 7.5 million jobs back online. It's going to be a very slow go recovery, in my opinion.
Hey, Dan.